Hi, everyone, and good morning. Welcome to our July workshop on government contracting accounting. This virtual workshop is part of our Demystifying Government Contracting series with workshops held every last Friday of the month. My name is Catherine Walsh, and I am with NBDC PTAC, and I will be your moderator today. NBDC PTAC is part of the Nebraska Business Development Center. We are a statewide program, and the government contracting services we offer include assistance with registrations in the new beta.sam.gov system, assistance with 8A, HubZone, women-owned, veteran-owned small business certifications and self-certifications, proposal and bid review, and assistance with post-award processes. NBDC has moved to all virtual events for the remainder of the summer and potentially most of the fall. The next webinar we will have will be on the women-owned small business certifications and will take place the second week of August. So coming up in the next month or so, on September 11th, we are having part 1 of our Meet the Buyers conference. We've decided to hold this year's conference in 2 parts due to COVID-19. The first part will be a half-day event of virtual presentations and speakers. We will have Joshua Frank from RSM Federal, GSA, to do a presentation on updates and changes. We will also have John Maddox from Co-Prince Law speaking on the Mentor Protege program and joint ventures. You can sign up for this half-day event on our eCenter page, and it is free. Part 2 of our Meet the Buyers conference will then take place on October 20th and will allow for you to meet one-on-one with federal agencies and buyers in a virtual format. So depending either way, you'll have the opportunity to speak directly with buyers, and we hopefully will get you procurement presentations from all those agencies and buyers ahead of time so that you may make your selection for your one-on-one meeting. For the full list of events and to register, visit ptac.unomaha.edu/events, which is also linked right now on your screen. And if you have any questions, you can always email me after this webinar. My email is cwalsh, WALSH, @unomaha.edu. Okay, so let's get started with today's webinar. During the webinar, if you have any questions, please type them into the question box on your control panel, and I will address everyone's questions at the end. We have quite a few handouts today, so if you have not already located and download those, you can find those on your control panel. The second to last tab says Handouts. And if you click that, there'll be a drop-down menu, and you can download all 5 of those handouts. And I was told by our speaker that he will be using some of those, or most of those, during the workshop. So if you would please download those beforehand, it will benefit you during this workshop. Okay, our webinar today is presented by Greg Hansen, CFO and Consulting Project Manager of Project Solutions, Inc. Greg Hansen holds a Master's of Business degree and a Bachelor of Science in Business Administration and Accounting from the University of South Dakota School of Business. He has 35 years of experience in financial and management accounting systems, training small businesses across multiple industries. As the CFO of PSI and Consulting Program Manager, Greg has prepared and trained clients on calculating pricing quotes and bidding strategies for government contracting since 2006. His knowledge and expertise on compliant accounting systems provide essential information for firms that want to grow their business with the federal government. So with that, welcome Greg, and thank you for being here today.
Thank you, Catherine, for the introduction, and I want to say thank you to the Nebraska PTAC folks for hosting this event. We've done several seminars over the years in the state of Nebraska for the PTAC SBA, so chances are maybe I've met a few of you along the way, but this is an important topic as you venture into government contracting. As accounting is so foundational, it's really a requirement to be successful in government contracting is having your accounting records to comply. So some of this, as we get into this, is it's a little dry as we talk about some of the FAR regulations, but then at the end, we'll be able to see how do you use this information. Remember, accounting is a tool, just like any other tool we use in our businesses or our lives, but it gives us information, if it's done right, that can help you meet the regulations, but also then how to price your business, how to price your proposals that maybe help you grow your business. I think we've got about, I think I have 75 slides or so, and I don't know how long how we go, but and I know Catherine said there'll be, if you have questions, type them into the chat box, and we'll want to address those later on. You know, the handouts are pretty important. When we get into the numbers part of our presentation, there's a lot of numbers, and on the screen they're hard to read. But if you print them off, I think they'll be more easier to follow along with. So you'll want to have those beside you, and you know. So this is a lot about accounting, and then you know, pricing, what we're talking about today. So I hope you like accounting. I like accounting. It is some people's least favorite part of their business, but if you're going to be in government contracting, you're going to want to learn it, and then also beyond, even if you're not in government contracting, how to evaluate your costs in such a way to determine, are my rates competitive? Is my overhead appropriate for my industry? So on this slide, the slides are numbered, so hopefully we can be able to follow along. We're on slide 3. So we're going to talk about what the DCAA is, what it is, what compliance, and their role in the federal government contracting process. We're going to talk specifically about Part 31, which is allocation of costs and building, proving your rates through your accounting system. We're going to talk about a compliant accounting system. We'll go through some steps of what that means. How to make your company's system compliant. Chart of accounts, which is the background of the general ledger. It becomes the skeleton, and processing job costs, payroll, materials, and other direct costs. Then we'll get into creating and using cost pools and bases as defined by Part 31, how that is done using your accounting records. And the fun part is strategic considerations beyond price. And then we got some examples here that hopefully you'll find useful. So we'll get into it. I'm going to put a preface here. Our content today has been developed by us based on what we've learned from experience, training seminars, research, mistakes, and successes. We're a small business like you, potentially. You know, we've been in business, just celebrated 20 years in business, but we've learned trial and error, you know, to get to this point. And so you might view it differently. You know, the federal acquisition regulations are subject to interpretation like any legal document, and it's often don't have a singular correct answer. Be consistent in your interpretation of the code, though, as you work in your business and document your practices. This seminar is intended to provide an introductory to federal contracting for firms considering doing business with the U.S. government. And the federal regulations, the FAR regulations, are over 2,000 pages. So, you know, we obviously are not going to cover those here, but I just want you to know it's out there, and you can go to where to look for research. As I said, you know, we've been selling to the government for about 12 years, and learning how accounting systems, how to price, trials, what pricing has worked, what we've seen, and how we've been with hundreds of firms across the United States, and you know, inside their books, and seeing them and distilling that into what works, and hopefully you'll get something here that will work for you. So just want to say that up front, that you know, this is our interpretation of it. You might see it differently, or you go to another class and go, that's not the way I saw it. You know, we're small business. We're not contractors. Sandy, the CEO, and we work together. Neither one of us has ever worked for the government. So this is from the small business side. So just let me get that out there. First thing I'd like to do a little overview of what's the difference between private contracting and government contracting. If you're looking ahead on your slides, you know, here we got a picture of, you know, if you've hired a contractor in your life to do some work on your house, you know, you say, well, contractor, my bid's $10,000. You say that's okay or not, whatever, and you go on, right? You don't dicker necessarily, or you don't ask them to prove their numbers. But in the government world, it's different, right? So I proposed $10,000, and here's my proof. And so that part becomes, for some companies, that's not a comfort zone. They don't like sharing that information. In a private, the private world, how the contractor calculates his or her pricing is their business, right? The government, though, you're going to be asked to show your financial records, explain your markups. How did you get at that price? In the private market, what you pay for your materials or your suppliers is typically nobody's business. The government, just the opposite. Biggie, is payroll. What you pay your employees is nobody's business. Really, it's between you and the employee, typically, right? On the government, you have to prove it. You have to show it. You have to show payroll records, and those payroll records have to tie together to W-2s. So it's highly regulated. So just be aware of those differences. This next slide, this is an eye opener. How is this possible? How can the IRS look at your books and say you're a financially responsible company, or the bank approve you for $1 million line of credit or a $5 million bond, construction bond? But then the DCAA can look at the same data and conclude your company is deficient and should not be allowed to receive a federal contract. How could three different entities have different conclusions about the assessment of your business? The difference lies right here. And there's different types of accounting for different stakeholders, and each has their own interest of what they're looking for. So financial accounting is backward historical reporting. It's used by investors and lenders to make decisions. Taxing agencies use it to ensure proper taxes are paid in highly regulated formats. The IRS wants to know, is all income reported? Are deductions legitimate? And they're worried more about income, right? And banks also. So they're looking at what's track record, past performance. Same as bonding companies. But we're moving into management accounting. We're looking a forward view, forecasting, budgeting, strategic planning of financial records. But biggest part of the difference is cost accounting. So the government wants to know, can you track costs using your accounting system that related to the contracts? This was public money. The government has to be able to prove where that money went. And there are people, their vendors, which you could be one of those, has to be able to support that using their accounting system. So that's why the IRS, a bank, or the DCAA can look at the same financial statements and see it differently, because they're all looking for something different, in a different perspective. So whether you make it a profit or not is not the DCAA's concern necessarily, but the other ones, it is. So does that make sense? So they look at your financial records differently than anybody else you've probably met so far in your business. So who is this DCAA, and why do we need to know that? Well, it was created in 1965 by Congress, and it provides contract audits for most government agencies. So if you're doing business with the U.S. Forest Service or the Department of the Interior or the Army Corps of Engineers, any of those, they will subcontract to the DCAA to provide audit services if necessary on their contracts. And if you read through the FAR 52, they're 0.215.2, this is authorized to be done. And if you dig through any solicitation you're looking at, you will find this FAR is incorporated by reference. There's a lot of, if you look at those, there's a list of them. So this is one of them. So, and it's ensure that taxpayer dollars are spent on fair and reasonable contract prices. In the news from time to time, you'll hear about a $10,000 toilet or a $800 hammer. I'm not sure where all that comes from, but the government is auditing contracts to make sure that the prices that were quoted are supported by the cost of the company, and they have the ability and to audit financial statements of their vendors as if they need to. They do follow the certified AICPA standards and the generally accepted accounting principles, which is mostly gets into accrual accounting. So if you will visit on that a little bit here later on. What do? They identify and evaluate the costs on government contracts. They want to evaluate your policies, procedures, and internal controls. Is your accounting system strong enough or robust enough to follow the regulations? And they provide audits. We'll talk about different kinds of audits here in a little bit to reduce or avoid costs. So they provide the audits and the capability for different agencies. And I said early on, the FAR regulations is thousands of pages, but we're going to focus on Part 31. And this is a part that you need to know if you're going to be in the government contract arena. And let's talk about some key definitions as we talk about Part 31. Direct costs. The direct costs are defined as any item, service, or labor that's used for the sole purpose of meeting the requirements of one specific contract. The item, service, or labor cannot be used for any other contract or company's purpose. And in the accounting, this is your cost of goods sold section. Okay, direct costs. Important that we understand that. Seems pretty straightforward, but can we get fuzzy as he's breaking down payroll into multiple tasks? For example, a manufacturing plant could have multiple contracts within it. One side is a private side, the other side is a government contract. And so the people who work there, you got to be able to segregate their payroll to accommodate that. So here's we got a little slide here of direct costs is materials, equipment, time, and labor required to physically build this car. Okay, that seems simple enough, right? The labor of those men building that car, for example, is a direct cost. And this, on our next slide, we've got the actual language from the FAR. No final cost objective or contract shall have allocated to it as a direct cost any cost if other costs incurred for the same purpose in like circumstances have been included in any indirect cost pool, to be allocated to that or any other final cost objective. Direct costs of the contract shall be charged directly to the contract. Direct costs of the contract shall be charged directly to the contract and not to any other contract. All costs specifically identified as other final cost objectives of the contractor are direct costs of those cost objectives and are not to be charged to the contract directly or indirectly. So back to you. So if an employee is working on multiple jobs, one is a government job, for example, and one's not, you need to be able to support breaking that out and proving that. You can't charge it all to one job. So direct costs. The next one, now indirect costs is not quite as straightforward. Indirect costs are any item, service, labor that's used to support or complete the contract's requirements, but also supports other contracts of the company functions. Indirect costs benefit multiple contracts or company functions. They include fringe, overhead, and G&A expenses. So this is where it gets a little tougher. So indirect costs are the items that support the completion of one specific car, but also support all cars that are being made in the factory. So when you look at this little picture of these people making these cars, how do you allocate the cost of this plant to each car? How do you take the cost of building that building, maintaining the building, heating the building, lighting the building, insuring the building, incorporate that into each car? If you're a contractor, if you're a construction company, how do you allocate the cost of running your office, machinery, the equipment equitably to one job? That's the challenge. So the direct costs, I think we can get our head around that. That's not too hard. This is the overhead, the indirect costs is a little tougher. And then the next slide, we have the actual FAR regulation that talks about this. Allocation of indirect costs shall be based on the applicable provisions. After direct costs have been determined and charged directly to the contract, indirect costs are those remaining to be allocated to intermediate or two or more final cost objectives. No final cost objective shall have allocated to it as a indirect cost any costs if other costs incurred for the same purpose in like circumstances have been included as a direct cost of that or any other final cost objective or contract. So you want to have to be able to prove and break out the costs that are not direct separately. The contractor shall accumulate indirect costs by logical cost groupings. And we're going to get into these, and we're going to call those pools. If you're making notes, if you printed this off, logical cost groupings are called pools, with due consideration of the reasons for incurring such costs. The contractor shall determine each grouping as to permit use of an allocation base that is common to all cost objectives to which the grouping is to be allocated. The base selected shall allocate the grouping of the basis of the benefits accruing to intermediate and final cost objectives. When substantially the same results can be achieved through less precise methods, the number and composition of cost groupings should be governed by practical considerations, should not unduly complicate the allocation. So then what this is saying is that there's a number of ways to assign indirect costs to direct costs, but we don't want to you don't have to break it down so much that it becomes too complicated. You know, this is legal language, but I think we need to review it to understand where the rest of us will be talking about. Once an appropriate base for allocating indirect costs has been accepted, the contractor shall not fragment the base by removing individual elements. All items properly includable in an indirect cost base shall bear a pro rata share of indirect costs, irrespective of their acceptance of government contract costs. Pro rata share, circle that. That's what we're going to get into. We're going to take these pools I mentioned a minute ago and the bases and figure out how we're going to do a pro rata allocation of these indirect costs. For example, when a cost input base is used for the allocation of G&A costs, the contractor shall, G&A costs is a pool, the contractor shall include in the base all items that would properly be part of the cost input base, whether allowable or unallowable. And these items shall bear their pro rata share of the G&A costs. Separate cost groupings of costs allocable to off-site locations may be necessary to permit equitable distribution of costs on the basis of the benefits accruing to the several cost objectives. That part F there. So let me clarify that a little bit. So you're an engineering company and you have an office in Omaha, but you have another office in Salt Lake City. And that office supports 3 projects you have going on in that region. You want to have your system, you don't want to burden your jobs in Omaha with the cost of maintaining that office in Omaha. You want those 3 offices in Utah to support the cost of that office. So if I'm a customer of yours, a government agency in Omaha, and I see that you're burdening your jobs with costs for operating an office in Omaha, I might say, I don't think that's fair to include that cost in your G&A rate. I think you should separate that out. And so that's kind of what that was saying, that you want to charge your indirect where it needs to be. Construction companies, if you have equipment, heavy equipment, of course, and you might have a shop to maintain it. Well, you want to just make the equipment bear the cost of maintaining that machine shop and the mechanic, and goes on all the support of that facility, and not incorporate that into your other rates. And that's for competitive reasons as well. You don't want to. You want to put the costs where what's driving it. And you'll hear me say that. Put the costs, the indirect costs, with the direct costs that are driving it. So we have direct costs, we have indirect costs, and there are some costs that the government considers to be unallowable. Now these are legit. These can be legitimate business expenses, but they cannot be included. They're not allowed in prices, cost reimbursements, or settlements under contracts with the U.S. government. The government is unwilling to pay for these costs as direct charges or indirect expense pools. The company is not prohibited from incurring these costs, but they cannot be used in calculating your rate. And we'll get to that here in a little bit. you want to separate general ledger accounts must be established for these types of expenses. They must not be priced into federal government contracts during the proposal process. And I've got a list here. If you go to the FAR, you can see this list. Advertising is not allowed in your indirect rates. Public relations, alcoholic beverages, bad debts, automobile costs that are for personal use, donations, etc. So these, excuse me, these costs are all grouped together in your chart of accounts. So, let's be clear. So these are typically allowable business expenses, right, for the IRS. Alcohol is not, costs of personal use are not, but otherwise, pretty much most of these are legitimate business expenses, but they cannot be used in calculating your indirect rates. One that's not on our list here, I don't think, is interest on loans. Yeah, so that is not allowable. So direct, indirect, and unallowable. So so now that we've got some key definitions here, how do we implement this as far as this FAR Part 31? It's through the formatting of your chart of accounts in your accounting software. Direct costs are costs of goods sold. I don't know if you work in the accounting department, if you're using QuickBooks or Sage or any of the government specific ones, you don't see often the word direct costs. You see cost of goods sold. Same thing with indirect costs. I don't think you see the word indirect. You see the word expenses. You're going to want to maintain source documents or receipts as much as possible digitally or on paper to support contract costs. The accounting system is able to collect costs according to contract line item numbers. And cleanse, those will become your service items, right? Or sometimes you can set it up as a sub-customer, depending on how your QuickBooks is working. Payroll allocated between direct and indirect. This is through your payroll setup. This is a very important part of the DCAA compliance system, is how you track payroll. You have payroll items need to be as direct or indirect. Each employee's profile will have several types of payroll to accomplish this. So this payroll and payroll items will be a big part of your programming. Compliant accounting systems. Let's see, will it click? Does it advance? There we go. Now, I've got 9 steps to a compliant accounting system. Somebody else might have 5, somebody else might have 25, but I've just distilled them here into 9 steps. So the accounting system compliance must be able to track costs by contract. If you're a construction company or professional services, if you do project-based work, chances are you are using job costing. You're setting up customers and sub-customers. You're tracking your costs as you buy them, or payroll by contract. But you want to, if you're not, this is good information. You need to set up job cost modules in your accounting system, whether it's by contract or by project. Accounting system must be able to track costs by contract. You can use the same process and logical every single time when you allocate indirect costs. The allocation costs are based on a fair measure. What is driving the cost? So as I said earlier, don't burden your labor with the cost of operating or maintaining a machine shop, or don't burden the company rates with the support of a facility that is open only for special contracts. Right there, circle that. What is driving the cost? You want to mark up your direct costs by using indirect rates accordingly to what's driving it, and that's done through grouping of pools and bases, which we're getting to. Number 3, this is all done under general ledger control. Individual job cost reports will reconcile to the revenue and cost of goods sold on the profit and loss statement. So if you look at your profit and loss statement, which is standard financial statement, your subsidiary ledgers of your jobs should add up to the revenue and the cost of goods sold. This would show that there aren't direct costs hitting your books that are not attributable to jobs. Post-transaction, use the appropriate module, accounts payable, accounts receivable, and payroll. Use general ledger journals sparingly. You can manipulate your financials if you're using general ledger entries, right? If you're a bookkeeper, you know what I'm talking about. Use those sparingly. Use the modules for accounts payable, receivable, and payroll to post through the process. It creates the tracking and the internal controls that you want. If you're doing general journal entries, those are usually should be used only month end. So for end of the month accruals. So your costs are controlled under general ledger control. It's coming, but you don't want to use spreadsheets to do your accounting. Number 4, your timekeeping process. This is, you have to have the ability to track the employee's time spent on each work activity. Must be recorded daily. Time is recorded by all employees. So even you, owner or superintendent or vice president, whatever your role is, you need to record your time by job or task that can be tracked and verified. All hours worked, salary hours, salaried employees included as well. Sign cards need to be signed. And this is the biggest source of deficiencies in any DCA floor check audit. And if you, David, that floor check audit is like a Davis-Bacon survey. And if you are construction, you may be familiar with Davis-Bacon, where they will question the employees about what are you being paid, what are your hours, and do you know what the minimum wage is for your work? So they will want to verify what kind of work these people are doing and what part is direct to the labor to the job and what might be shop time or training time, so that the government's only paying for the direct time working on that job. Number 5, timekeeping labor costs. The most common reason is timekeeping. The floor audits is not meeting timekeeping requirements. They want to know how their employees record their time. They're dissatisfied with your overall timekeeping systems. Employees don't own their timesheet. This is a big one. You know, it's Monday morning and everybody's working on their timesheet for the previous week. You'd like to get out of that habit. You need to have more training on how important it is for them to keep their time. A little suggestion here that maybe during a safety training, you get everybody together and talk about timesheets, and that they're, you know, again, I mentioned Davis-Bacon. If in the morning your worker is the equipment operator, in the afternoon they're, you know, a laborer or setting forms, those are different pay rates, different tasks, and you need to be able to have the paper trail to support the differentiation of those duties in that example. So it's a little more work on the superintendent's part, but it's compliance with the contract. It also helps you understand your job costs and your estimating and how you are you hitting the estimated prices that you'd put in when you started the project. Very important, timekeeping. Number 6. Once you've collected your time data, your TimeKey system has to have the ability to track labor costs and hours by contract, by job, or project. It also has to have the ability to track mechanism for these indirect type costs of G&A and non-project related personnel. Quarterly reports need to match the 941s. So the payroll reports for your employees should roll up to what your 941 says. So that's the key part. So even though you hired this person to be a laborer or a direct labor person, chances are that person's going to have some labor that is not direct charge, right? So in that person's profile, you're going to want to address that there's safety training time, there's maybe travel time or shop time where they have some downtime. That you don't want to break that out, be able to charge that to those indirect costs, and that through the accounting system is building that as an indirect cost pool and not a direct cost to a job or cost of goods sold to your company. You know, so as I say, in the small business world, payroll deficiencies is maybe the biggest hindrance on compliance is all the payroll. So number 7, routine posting of books that you're producing monthly financial statements in accordance with GAAP. And the biggest part of GAAP in this conversation is accrual accounting. You know, we don't like to pay taxes on work we haven't been paid for, which makes sense. So that's called cash basis accounting, which is great for taxes, but lousy for running a business. So if your accounting system is set up where your reports are being generated on a cash basis, you want to switch to an accrual method right away. As I say, cash basis accounting is great for tax purposes, but a lousy method to run a business. And you want to get in that habit right now, if you're a government contractor, to be operating on an accrual basis. And this is, you know, especially in construction or project-based work, is how to record revenue. Is when you, at the end of the month, record what revenue you've earned. So accrual accounting will be an essential part of your business if you're going to be successful in government contracting. On to number 8. Let's come on slide. There we go. Indirect costs are those items that cannot be pooled with other indirect costs. You got to be able to create pools of indirect costs, separate the unallowables. Common error: the contractors are not separating out advertising, interest, and charity costs. So, number 9, cost by line item. Your accounting system must be able to track costs by line items. Now, here I have an example. If you have a $100,000 contract and there are 3 different items on there, that you need to be able to track costs in your accounting system by those CLINs, or contract line item numbers. The system requirements, it's not the software as much as it is your processes. You know, you got to use double entry, no spreadsheets. I've seen some elaborate accounting systems done in spreadsheets. You must follow generally accepted accounting principles. Revenue recognition: when is a sale? And when is the interest? When is the revenue earned? Must be verifiable. Subsidiary ledgers must match up to the general ledger. Ensure that all direct costs or job-specific indirect costs are not intermingled. So if you're getting started in government contracting and you become certified in either S8A or veteran-owned or any of those, you're going to start getting solicitations to say, we will sell you a compliant software. Well, you don't have to buy one. It's the QuickBooks, which is, you know, probably 80% of small business now. Off the shelf is not compliant, but it can be programmed as such. I met an engineering company that had trouble getting approved because their record keeping was inadequate, so they went out and bought Deltek for $25,000, and now they're learning that they probably didn't have to. There's types of audits, but we're gonna get down here to the most common ones here, which is, so we've been in business 20 years, been government contracting for most of that, and we've been audited twice, and it's just by this SF 1407 and SF 1408, which go hand in hand. They want to make sure that and that's one of your handouts there. If you have have those near you. You want to look at those. They want to verify if you're awarded a contract, chances are you might get one of these forms by email from either the contracting officer or the contracting officer's representative. So they want to see if your systems are able to support the accounting systems that they want. So this is on next slide. This is a standard form 1407, and this talks about some of the things we just discussed. Is it proper segregation of direct costs from indirect costs, and so on down the line. Over there on the right, they want to know your forecast, your sales goals for the next 6 months. We're going to switch slides here to the next one that has the same thing. So this is your financial records. I want to know if you are a federal contractor or federal creditor to the federal government, if you have an SBA loan. Again, they want to know your forecast. They want to know your backlog for the next 6 months. Why do you suppose that is? What are they looking for? They want to know if you have the capacity, if they award this job to you, are you maxed out? So just something to think about as you fill these out. If they see that you don't have enough resources to staff the contract or fulfill the contract, they might, say you weren't compliant in that regard. So on to pools and bases. Okay, here we go. So this is getting into the meat of it. Pools are indirect costs accumulated according to their relationship to each other. Their payroll, occupancy costs, or insurance as an example. Bases are direct costs, and both must be created by your general ledger system. Okay, both must be created not by hand, but you need to set your chart of accounts up to create these. Remember, bases are direct costs to a specific contract, and the equipment hours used on a job site, rented or company owned. How do you equitably charge equipment to a job? You also have direct costs or subcontractors, and those are pretty easy. And materials. And your tracking and accumulating bases are done through the chart of accounts, how it's set up, how you program it, and then the daily routine you have in your company that builds that data. Remember, bases are direct costs to a specific contract. Direct labor on that project and only that project. Equipment hours and miles used, subcontractors, materials. This is all done through your accounting system and your chart of accounts. So those are how about now pools? Let's look at pools. Pools represent indirect costs. They're accumulated into logical groups based on the benefits accrued for several projects. The use of base cost activities creates the pool of expenses over a period of time. It can be both fixed and variable expenses. Fixed is rent, property taxes, and administrative payroll. Variable expenses could be utilities, insurance, or vacation and holiday pay. Types of pools, and we're going to talk about 3 pools. And some of them, and remember we read the FAR, not to overcomplicate it. So we're going to talk about 3. Some you'll see will have 2, some will have more than that. We're going to talk about 3 pools, setting up 3 pools, indirect cost pools in your company. Okay. Remember, these are costs that are attributable not to any one job, but necessary to support the operations of the company. It's all set up through your chart of accounts. Fringe pool, that's fringe, we didn't say fringe benefits, but it often is. So you're going to want to create a pool on your chart of accounts that tracks all these costs. So if you have employees who have vacation pay or sick or holiday pay, you want to set up payroll items for those people and track those hours separately. And those would be, and as they hit the general ledger, they would hit in this fringe pool also. So workers' compensation, your employer contribution to a payroll plan or pension plans. So there's modify your chart of accounts, set up a fringe as the main, but it's a non-posting account. Other accounts become sub-account. We'll have some examples here if you did printed off those handouts. And here though, so the overhead pools, we just talked about the fringe. Let's talk about the overhead pool. This is costs that support project work, but applicable to multiple projects. I mentioned the machine shop, branch offices, not used too often, but if you have a machine shop, you're going to want to separate those costs and allocate the cost of that machine shop and the equipment only to your equipment and not to the other components in the company. The general and administrative, this is the G&A is the most widely used one. So corporate salaries, estimators, administrative support, incidentally, if you're a construction company, a superintendent is generally an overhead. I say, you know, in the industry vernacular, whether you consider that person a direct cost, it is supporting multiple projects, but typically when they're talking about gross margin on projects as a construction company, superintendent is a supervisory and an overhead cost, not a direct cost. So whether you consider it that way or not is different, but that's just industry standard. Your company insurance, office expenses, building repairs, software licenses, etc. You know, corporate travel is not chargeable to budget. Those are examples of some of the G&A pool. And here's just a sort of a quick chart. You can maybe print that off or save it so that you can. So there, right there, we have 1, 2, 3. We have 4 pools as examples for maybe you have one for materials. So now let's get into it. So we got the kind of the bones of this. Now let's talk about how to use this stuff. So this is where I think it gets kind of exciting. If you like math and accounting, I do. This is where how do you use this and how do I apply it, these numbers? We need to come up with these indirect rates. This is it's a calculation. We're gonna remember back in the reading of the FAR regulations, we need to do a allocation on a pro rata basis, and that's what we're getting to here. We need to divide a pool by the base, such as direct labor. The allocation base utilized for distributing indirect expenses is the method that allocates the cost most equitably to the primary cost objective or the contract. You know, so allocation base could be used on other methods. You know, thinking back to the picture of our auto factory, you could use the cost of running that plant could be allocated on number of cars produced. So much we're gonna build 1,000 cars this year, so we're gonna take the cost of this plant divided by 1,000. We're gonna add that much 1/1000th to each car. So the cost should represent indirect costs accumulated by logical groups that are relatable to each other for the reason that they are grouped, and distributed on the basis of benefits accruing to the relevant portions of several cost objectives, which remember means contracts. So indirect rate. And we're going to use this rate to mark up your direct costs. It's a break even. There's no profit added yet, depending on the complexity of your company or the industry. You can use several different kinds of indirect cost rates. I mentioned here's G&A, equipment, materials, payroll, remote site overhead, whatever. Being able to gauge what your rate against industry norms is going to be important, and we'll talk about some of those. So here I've got 5 rates you could use, but we mostly see the G&A and the payroll fringe. Those are the ones that we typically so. Next is the formula. There it is. Indirect cost pool divided by allocated base equals a rate, and this is a percentage. So become your new best friend right there. You know, and I want to, you know, we can overthink indirect rates, and we do. I mean, we're overcomplicating, but really what it is comes down to is of a company's total costs, how much is for the work I do, and how much is everything else, right? That's really what we want to get to. You know, the government has its regulations about, you know, good regulations that you need to separate your direct costs from indirect costs. But it's you, as the owner and the estimator, want to understand. You're going to get your head around is what % of my costs are running this company, and what % is the work that I do. You got a couple of contractor A, indirect costs are 60,000, and their direct costs are 40,000. Well, that's not very good, is it? I mean, that's an expensive company. Contractor B, direct costs are 80,000, indirect costs are 20,000. So that's getting better. Here, contractor C, there's a construction company. So there's only $10,000 of their total expenditures supporting the $90,000 worth of direct costs. You see what I mean? So like I said, try not to, if you have a hard time appreciating that, I think this illustration can let you see what indirect costs mean, what we're getting at, how much do I need to add to my direct costs to cover absorb these indirect costs in such a way that my overhead is being paid for by my customers. And if your relationship between direct and indirect is out of whack, it's going to be tough for you, right? So that's really, the FAR requires a separation, but your company needs this information. And we'll be using those percentages here in a little bit more. So anyway, so save that slide. I think that if you're complicated or confused about indirect and direct and FAR, this really, I think, tells you what the objective is, especially as you get into competitive bidding and strategic implications of that. So here's a little worksheet here. The next slide has the answers. We don't want to, but if we have time, we'll go through these. And if we wanted, this is a company, if we just took all the costs of the company, our example here is 657,000. Spoiler alert, if you look at the next slide, it has the answers. But if you could take those costs and put them in the appropriate column, you get an idea of how your QuickBooks or your accounting system needs to do the same thing. Now we're gonna go through so I've broken them out, and if you have questions about why it's there, please type that in any time if you have questions. I'm going too fast. I apologize. There's a lot of material here, a lot to absorb. But if you have questions about why the amounts are in those columns, please type in the question and we can discuss it. But subcontractors are always a direct cost. Technical support labor. This example was a architectural company. They don't sell widgets; they just sell labor. Okay. Here's how we calculate the fringe rate. So if you want to look at that previous slide, with the fringe cost divided by our direct labor is 48%. And this is so now if this is how to apply this, or how to think of this literally, is for every dollar of labor you have in this example, you need to add 48 cents to absorb the cost of that labor. That's payroll taxes, that's workers' compensation insurance, that's vacation pay, holiday pay for everybody in the company. If 48%, in your company, you'll find out what yours is, but that's how that's applied. That's what that's saying. That 48% is absorbing all the overhead, indirect costs necessary to run the company. Okay. And now let's look. The G&A here. You see, G&A is 163,500. Okay, the G&A pool is all company expenses that are not direct, fringe, or other unallowable are part of the G&A pool. The base is the total cost input. Now all the costs in the company are what that means. So this example, our G&A rate is 26%. And in English, or in language, for every dollar of direct costs, labor, equipment time, whatever it is, whatever direct cost, if you add 26% to it, the overhead of the company, the indirect costs of the company, are going to be absorbed by those projects. I want my customers to be paying for my overhead. And if I add 26% to my direct costs, those will be absorbed, and that will happen. Does that make sense? That's what we want to do. We want to provide enough markup for that the projects will absorb the overhead of the company. Okay. Now you're going to want to get a hold of your handouts, the black and white one. This is the one that's, and then what I've done, and I've on this next slide, we're on slide, how are we doing for time? Or we're a little behind maybe, but so what I've done, this is an actual business, and on the slide I have the P&L printed off. I exported it to Excel, and you see it's side by side, and I put the line numbers on there, so you can see we can reference it more quickly. So this is good. This company has a good track record, strong accounting department. It's the second year of selling to the federal government. But what we want to do is we want to rearrange these general ledger accounts into pools of direct, fringe, and G&A. So let's look at the top in the income section here. So this is usually we don't use this this is not a direct or indirect, right? This is just a revenue part. But they are breaking out their 8A work separately. They're tracking that separately. And the cost of goods sold. This is again an engineering services company. See discounts. Discounts are typically not a cost of goods sold. That should be a offset to revenue. Also, I don't see any employee labor there. I don't see any staff labor there, right? Over here on the far right on lines 79 through 87, they have professional internal staff salaries of $2 million. So some of that needs to be broken out. So right, we need some of the cost of goods sold has to be this professional internal staff salaries. Okay. So this is just a P&L exported to Excel and put side by side so you can read it on the screen. Okay. The next slide is the same one redone for DCAA compliance. I'm building my pools and my bases. And you can see they're color coded. Same for financial information. The net income for both of them is at $363,695.50, right? So, and I've got over there in lines 31 through 47 is the fringe, and in the green, if you print it off in color, 60 through 124 is my G&A expenses, and my unallowables are 125 through 132. Okay. So if you hopefully you have room on your desk where you were able to put those side by side to see the difference. And okay, so this is our cost of goods sold, where I've taken that $2,051,000 worth of salaries, and I put down I think 60% is as a direct cost of goods sold. So I've moved it over there. The rest will stay as G&A. Again, you want the accounting system and your payroll system has to do that separation for you. For our illustration here today, I made an assumption and I moved most of it into cost of goods sold. But you want your payroll system to calculate that directly. You're a professional services company, and people, not every hour is billable to a project, right? You need to be able to separate those out internally in their payroll to do that. I know I'm broken record, but you need to have that capability. This is our revised cost of goods sold here on slide 59. Slide 60 there's a fringe pool. This is payroll taxes, employee insurance costs, 401k. These are the employer's contribution, not the employee's cost. You have cost of health insurance, life insurance, workers' comp, holiday and vacation pay. So, it is part of payroll, but you want to segregate it into this fringe. So, there's 2,080 hours a year, right? Well, but the customer's typically only going to pay you for the time they're working. And if you get 2-week vacation and there's 10 federal holidays, they're working 1,920 hours. Well, you want to calculate or catch those other 160 hours in this pool. That's how that's done. This is all done through your accounting system. you process payroll each week or bi-week, however you do it, which you got to be at least bi-weekly for government. And monthly doesn't work. But so this information is gathered as you process payroll, and your chart of accounts is set up. Okay, next one, here's the G&A pool. Again, this is taken right off of the handouts that you have. You have the black and white version, which is right out of the QuickBooks, and the color version, which is where it's been moved, the accounts have been moved around to create the pools of fringe and G&A and unallowables. Okay, hope no one's lost. And then this means, here it is. So here's our rate calculation. So using this company's actual financial information, we were able to create our fringe rate and a G&A rate. Everybody see that? So there's an Excel that if you ask Catherine about, she will email you the Excel. We wrote it, we created it's yours to have and use. It's not copyrighted or protected. So just how you can do the same thing in your business. So okay. So these on slide 62, where the fringe pool, our direct labor is the denominator, and our fringe rate is 32.2%. Again, in other words, this company needs to add 32.2% to direct labor in order to capture the costs and recoup, I say, absorb the cost, the fringe cost of all employees for the work that they do. That's what that does. G&A, I want to add, for this example, I'm going to add 41% to everything, all my direct costs, so that those projects will absorb the cost of my company, operating my company. Okay, and this is a very useful. Okay, so now we've got our rates, right? We've gone through our financials and we've rearranged them. We've got our fringe pool, we've got our G&A pool. Now, how do I roll that into my bids? So here it is. Here's how you do it. For example, this person is getting paid $25 an hour. So using my fringe rate of 32.2%, I'm going to add $8.05. I get a subtotal of $33.05. Now my G&A rate is 41%, and that 41% is added to the $33.05, not the 25, but the $33.05. I need to put the G&A on all my costs. It's 13.56. Subtotal is 46.61. Next, you can add a fee. The government allows companies to make a fee or a profit depending on the risk of the associated with the project. On this example, we've added 10%, 466, for a total of $51.28. So this person is being paid a base of $25. I'm going to charge the customer $51.28 for that person's work. So now let's look at this. How realistic is that? Or what? So that's a 2.05 times multiplier. So we've seen multipliers as low as 1.4. We've seen engineering and architectural firms that are, this is 3.5. So we got some strategic talk to have here in a minute. But see that? So then if I'm selling it, this person, 1 hour of time is $51.28. My direct cost is $25. My gross profit is $26.28. I'm making a 51.24% gross profit on this 1 hour of labor. Because remember, the fringe is part of my indirect cost. It's not a direct cost as you think about it. You might, as you price out yours, you think, well, you got to pay all these FICA and workers' comp, and as you come up with an hourly rate. By doing it this way, you've gone through you've built your pools and your bases. You know, you need to, if you add 41% to the cost of one person's labor, you will be capturing all those costs right there. Hope that makes sense. If it doesn't, right? So you don't have to do that individual calculation. We've gone through, your financial statements will support that by adding 41% to your labor, you are capturing all those costs, indirect costs associated with those workers. Success as a government contractor, prepare now, okay? And then I got a cute little slide here. And this is exciting material, who's lost? Yeah. If you don't like accounting, or if you don't like numbers, but maybe not. But now that we have the numbers, if you're the owner, you're an estimator, you're a business development person. This gets a little more interesting here quickly. We're over time already, but that's okay. We got good stuff here. I hope you find this beneficial. Okay, we've gone through the DCA. We talked about compliance. We talked about accounting records. We talked about chart of accounts to build pools and bases and how to use those using Excel, calculate those rates, how to roll them into get a rolled up, fully burdened labor rate. Now let's talk about some other ways that evaluate that. Is a higher price better? When you price it very high, people assume your product must be better. Even if your product is, government contracting, even if your product is better or really good, it's not necessarily what the customer is looking for, right? If the RFP says 5 years experience and your candidate has 20 and he or she is a rock star, they've been here, done that, it doesn't matter, right? The government's paying for they want 5 years of experience and maybe a bachelor's degree, and that pays X. And your candidate pays 2X or 3X, you're not going to win, right? So trying to embellish your candidate, who probably is probably qualified, doesn't necessarily matter in the government arena, because that's not what they're buying. So we've come across that several times where we'll have a stellar candidate, but the solicitation, is not looking for a person like that. So think about that. So as you meet people and how you shop, trying to find the best person when you're selling Cadillacs and they're buying Chevys, right? Considerations beyond price, okay? So if you go through these formulas and mathematically, smaller and newer companies have a higher indirect rates than established larger firms. You don't have the revenue base. And if you're using predefined formulas, will make your prices uncompetitive on a competitive price bid. So there may be strategic reasons to bid aggressively. Encourage you to calculate margins using dollars as well as percentages, right? So we pay our bills with dollars, not percentages. It's a good example. So how can a small company or a new company compete? I had one time when we did this, we went through all this, and an attendee said, "So you mean if I use my actual overhead rate, I probably won't win? In a totally low-cost environment, that is probably true." And another time, an attendee said, "So if I want to be a $20 million company, I need to bid like a $20 million company." And I said, that's exactly right. So if you're thinking, so if you haven't, you lost out on a bid and you say the winning bid was half a year's, how's that possible? How could that doesn't even cover my overhead? Well, so think about that. The world doesn't want to pay our overhead direct, right? They know it's in there somewhere, but we got to be competitive. And we'll have you some metrics here that you can think about. But here's what's going on in the economies of scale are the cost advantages that enterprises obtain to size, output, and scale of operation. You probably heard this word before, and it's used a lot in startups now. The cost per unit of output generally decreases with increasing sales as fixed costs are spread out over more units of cost. Often operating efficiency is greater with increasing scale, leading to lower variable cost. Larger volume also allows operating expenses to be allocated over a larger sales. But right there, circle that one, please. Larger volume allows fixed operating expenses to be allocated over a larger sales base. And the Walmart effect, whether you like it or not, there's a book written about this, about the Walmart effect, can drive down operating costs small businesses too. So the example I said about bidding like a $20 million company in order to be a $20 million company is applicable to this situation. And my next illustration here bears that out. A contractor we had met was doing commercial residential lawn maintenance and irrigation repairs, 15 years. Charges $20, $40 an acre. He charged $40 an acre, time and material for system repairs. And in a season, he would make about $50,000. And he had an opportunity to bid on a large ground maintenance contract at a military base, 5,000 acres, big 5-year contract. Using his rate of, he had a special rate of, half his usual rate, $20 an acre, and his bid was about $600,000 for this time. And the winning bid was $341,000. So we unwrapped the proposals. We sort of reverse engineered the prices. So we just went through the cost. What was the cost he would need? How many people he would need to do this work? And if we did that, if he would have wanted at $606,000, he would have made about $200,000 on that project. And we did the same thing with the winning bid of $341,000. How many people we thought it was going to take, the equipment was going to take. And he thought the winning contractor would make about $40,000 on that contract per year for 5 years. So into on top of the 50, so he could have been making 9 in this example. So, but you see the illustration, the economies of scale really pulled down the cost of this project, that he could have bid a lot less than his 600 and maybe been successful. So you got to think about those. That's why I say think about the gross profit you're going to make. If you put your numbers together, what's the gross margin on this job? Is it realistic? Another one, there's considerations beyond price. As you get into this journey of government contracting, you got to decide how deep you want to go into this. You need to build new client relationships, even though this is the government. People like doing business with people they know. You need to get your name in front of them, whether, you need to build connections with the people who are decision makers. You need past performance, critical. You need to just get that first contract where they have to do it for no money. Who does that, right? I'm not gonna make any money on this job, but I need to get the past performance. I need to get that going. Also the revenue from these contracts will staff new payroll, new people. They can be helped to develop future work potentially. And it's a multi-year. If you can win a 2 or 3 year contract and make something on it, build again. It's back to the considerations beyond price. That's you gotta think. What is your goal in this? And low volume, technically acceptable. Low price, technically acceptable wins. So you got to think about strategically what is your goal in going down this path. So get to the end here. Remember, what's driving the cost gets the overhead. How much market was appropriate? Subcontractors. How much markup do you need to put on a subcontractor? Do you put your G&A rate on a subcontractor? Are they driving the cost? You tell me, but typically not, right? Direct labor, that's where you make your money. That's when you want to load up the most. It takes a lot of resources to manage your employees. Owned equipment also. You need to be able to allocate your indirect rates to the owned equipment because it's expensive, and that's where you can make a lot of money on equipment. Materials, again, what's it cost your company to support building materials? Usually, so don't put a G&A rate on your materials. Each project has to be evaluated on its own. What's the mix of subs, material, labor, equipment? If you're just hiring all subs and you put 26% if you put all your G&A on your subs, you're never going to win, right? You got to be really think about that. If you're using a lot of subcontractors and you're going to make marginal, so think about using, you see this where in construction, or to be a general contractor, you got to be really, you got to scale that, the Walmart effect, you got to be at 20 million plus to be competitive if all you're using is subs and you're doing very little of the work. Think about that. Being strategic and working up subs, because you will not be successful if you're using a lot of subcontractors and you're trying to make a living off those subcontractors, unless you're at scale of 10 million plus in annual revenue. I would suggest. Our summary here: government can require contractors to improve their rates. Be prepared. Don't have a system. You don't have to buy a compliant accounting system. I mentioned this earlier. Compliance is rooted in your software programming and internal financial processes. Yes, so Deltek, we've looked at Deltek. It's a wonderful product. It is. It depends on your capability. If that you don't feel comfortable in doing what we're discussing here today yourself, or hiring that with your accounting team or your finance team, maybe you need to buy a Deltek type system. But it is, it's 20,000 and up front, and I think the setup fee was another 17,000. And so I don't want to diss them, but I'm just saying that's your system off the shelf. Those would be compliant, whereas the other ones, QuickBooks, Sage, some of those are not, but they can be. It's your software programming and the processes thereafter, not necessarily the software. Trained bookkeeping staff personnel is essential. Again, FAR compliance is a specific topic generally not taught in accounting or bookkeeping curriculums. Cost accounting, management accounting, this is your accountant who you may have a relationship with, is a good resource, professional resource, may not have this expertise, but that's, again, it's not something they're taught. It's just very specialized skills. So accounting programming takes some time. If the Deltek, I mentioned it was $17,000 just to program it for us. And switching over, that'd be a huge commitment on our part. And as you implement this, it'll take some time as well. After that, the internal processes will implement the compliance. And what's the most important attribute for your bookkeeper is detail oriented. Know what your fringe rate is. How to build that into your bids. We showed you how to add that. Is it competitive? And the fringe rate will capture the fringe costs of all employees. So one thing about government contracting is the benefits are pretty much, and the base wages are pretty much defined, aren't they? We're all Service Contract Act or Davis-Bacon. So the fringe rate is fairly competitive across most industries because they have to have the same benefit package you do. G&A rate is where it gets tougher. That's where you have to really be aggressive if you want to get going. Consulting firms, maybe it's 60, it could be high. Construction companies is low. Unravel your bids. What's the gross profit? Rule of thumb, general construction is 20%. Professional services is much higher. They're much smaller revenue as well. Added benefit of compliant accounting systems: use the accounting information for pricing proposals. That's it right there. Another one, don't be intimidated by 50+ page RFPs. You see them all the time. Get started, get a system, develop relevant templates for quicker response, get on the GSA schedule. We see more and more, the government's got a lot of turnover in the contracting offices, and writing full proposals, RFPs, is time consuming and complicated, and so they use a GSA schedule, which, it's like, I equate it to the old Sears catalog, where you get in the catalog and you've already been vetted to a certain degree, so it makes it easier for the contracting officers to use you. So I would encourage you to get on the GSA schedule, and they've got new systems, and PTAC is an excellent resource are helping you with that. So it's much easier for the government to solicit services through the schedules than going to full RFP. Develop a proposal process. Set a goal, one a month, one a week. And also if you look at proposals, you read through them, think, we can do that work, think, can we win? Because writing those proposals takes a lot of time. So we had people, there's, don't just think, oh, that's right up our alley, we can do that, but think, can we win before you dig in it too far? So a lot of information in a short period of time. Oh gosh, we've gone over, but there's some, our final slide here, some links to some FAR if you want to read the whole thing, the DCA manual, my contact information. So we covered about what the DCA is. I wouldn't lose sleep over it. Just get your accounting system, be prepared to have those SF 1407, 1408. Just go through it yourself. Self audit your company. Can you meet those requirements? If not, what do I need to do to get there? Then look at your indirect rates, your fringe and G&A. Are they competitive? How do you apply those to your labor rates to be successful? Again, the PTAC people, they know this space. They're in it all the time, and they're a great resource. And Small Business Resource Center. If you have any questions about any of this, please type them into Kathleen, and we can go over those, or Catherine. Sorry, we have Kathleen in our office, I think. Catherine, and we'll address those. If you want to reach me offline, go ahead. You're welcome to. Again, thank you very much for taking the time to attend today. I encourage you to take all of these you can. Just any training you get. People ask me for advice, say just learn everything you can. And if you pick up a couple of pointers, it's a good use of your time. That's all. Because it's then really decide for yourself, what is your goal in your business? What do you this is a great avenue to be in government contracting. It takes time, but it can be worth it. So with that, we'll turn it back over and we'll wrap it up.
Thank you, Greg. I have a couple questions already from Bryant. Do contributions to a 401k count towards your fringe rate?
Yes, they do. The employer, not the employees. The employer's portion of it is part of your fringe rate, yes.
Okay, and a question from Verna. Admin activity for a specific project is not chargeable to the project. So is that unallowable direct or is it indirect?
That's part of your G&A pool.
Another question. Oh,
I was gonna say you can still charge it charge it to the job, but you're gonna have a G&A part of that job. But in your financial statements, that is not a direct cost of the job. That's part of your government considers that to be part of your indirect rate.
Okay, thank you. Another question from Bryant. What are competitive rates for fringe overhead and G&A in the DoD space? What is a competitive multiplier for a high-end engineering company?
Well, if you hope you heard some pointers in there, Brian. The fringe rates in the government arena, again, Service Contract Act, most benefit packages are specified, right? So the vacation and time off and holiday pay that you have, your competitors have the same way, same thing. Payroll tax is the same. So fringe rates don't usually vary that much. So what's a competitive one? I'd say 35, 40. A high-end engineering firm, you say high-end, which I think if you're, back to my Chevy versus Cadillac, what's the government buying? I met a woman, she was charging $250 an hour and she's wondering why she wasn't getting much work. I said, that's not how the government shot you. You are qualified. You are excellent. But that's not what they're buying. If you want to get in this business and grow, you have to get down to like 140, 150. And that was back to the, what's her goal? Why does she want to be in business? I said, if you want to hire people to help you do this, you need to be in that 130 to 140 an hour, not not 250. I think what was the rate? So multiplier, again, I think we've seen professional services. So if you're paying somebody, I don't know, $50 an hour, multiply that times 1.3. We've seen it that low. In the, private, we've seen it was 3 times. We might charge $150 an hour, $200 an hour for that one person. That's not going to win in the government arena, just FYI.
Okay, thank you. I have another question from Verna. For a startup engineering company, is the self-pay health insurance a fringe benefit, or does it have to be company-provided health insurance?
It has to be company provided, company paid.
Okay, thank you.
Mm-hmm.
I believe that is all our questions for today.
Okay.
As Greg said, there's his contact information, and he's been very generous in allowing you to contact him directly if you have any other specific questions about today's workshop. I also have that Excel worksheet from him that I will email to anyone who attended, so look for that later today. Oh, so sorry, there's a follow-up from Berna. So if the company pays for self-insurance, is that then a fringe benefit?
I'm not sure what self-insurance means.
Yeah.
So that, but any health insurance paid for by the company is part of your fringe rate. And
yeah, I wonder if potentially if there's like if it is, you know, a one-man show still, and they are paying their own insurance.
Right. You're going to also, good question, Verna, and anybody else listening in, is if you're a one person or two person and you're the owner and you're not taking a salary, you're taking draws, you need to switch that immediately. You need to be getting a paycheck. Otherwise, it's not going to hit the books right. You're going to have a hard time proving your rates when that time comes. And your benefit, your company, you need to pay that premium for that insurance through your company. You need to start building that track record, like a regular business. You got to get out of that mold of a one person. Yeah. So good. That's an excellent question.
Okay. Verna is asking also, is there a limit for owner's compensation that is allowable?
Yes, there is. It's got to be realistic. You got to look at market rates. You know, if it's again, if you want to pay yourself $200,000 a year, it's up to you, assuming the company can afford it. But you know, the government think about competitively. What is an engineer? What does the primary engineer make in your area? Maybe he or she makes 150. You know, so if you were paying yourself 200, now you've just raised your indirect rates. And you know, can you be competitive at that? You might want to look at that in that example of, you know, the going rate's 150 and you want 200, taking 50 grand as a draw. You know, so you got to price to market. You know, so don't think about, you got to be really arm's length in this. That if everybody knows what that means. So if you're the head engineer of a firm and that person makes 150 a year or 100 a year, whatever it is, that's what you need to make. If you want to take more than that, I would, you know, the company can afford it. You can take draws or dividends. Hope that helps.
Yes, thank you, Greg. Okay, so I will email everyone that Excel worksheet, and if you would like a link to the recording, it did record successfully, so please email me afterwards. And thank you again, Greg, for being here today with us.
Hey, thank you everybody for taking time. I really enjoyed it. Wish you much success in your career.
All right, have a great weekend, everyone.